In December, he was extremely hawkish. And he was basically like, listen, we're going to keep rates higher than you like and longer than you want. And that was pretty clear, and the markets reacted. And then not but 35, 40 days later, he essentially said we have two 25 basis point hikes left to go. And he's going to try to stick the landing, essentially. And even though the rest of the language in his entire speech and the press conference, if you read it in the absence of his body language, so if you just read the transcript, would seem very hawkish as well. But the reality was he basically capitulated. And then the market essentially said, okay, we're at the end of this thing. And we've talked about this before, but markets tend to bottom 6 to 9 months before it's clear that you could have done this. And so we're a little bit off to the races in the short term. It's compounded by a couple of other factors. One is that at the end of last year, so many people were tax loss harvesting, which means if you had some gains somewhere else, you sold some things that were losing money so that you could net the two together. You saw a lot of stocks. Tesla was probably the poster child for this, trade all the way down to like $108 a share, and it's effectively doubled in the last 30 days, right? So everybody tax loss harvested, everybody degrossed, nobody was really owning anything. And then when Powell basically said we're mostly done, there's been so much systematic buying right now that nobody's really well positioned. To me, this is very similar and eerily reminiscent of the end of 2018 and beginning of 2019. And if you guys remember, at the end of 2018, October, November, December, the markets just fell. And part of it was Powell's going to raise rates, inflation's getting out of control, et cetera, et cetera. And then we got all this data that said China may be entering a real period of malaise, and Powell capitulated, again, trying to stick the landing. And long story short, he didn't. That was a head fake, and the markets just ripped higher. Then we went into the COVID pandemic and all of that stuff happened. So I think we're about to replay a little bit of that, at least in the next 30 to 90 days. The pain trade is to go up. So that's probably where we're going.
I think we're in the whipsaw economy here. Just a month ago, sentiment was incredibly negative. On this show, we were predicting for the year that we were looking at the Fed funds rate going from 4.5% to say 5.5%, 250-point increases. The belief was that we were going to have a recession later this year. I think that was pretty much consensus. And now, 3 weeks later, you had a situation in which we got a couple of really good inflation reports. So all of a sudden, the consensus changed to, we're not going to need to raise rates, to 5.5%. Maybe we only get one or two more quarter point rates. And the market just ripped on the belief that inflation was in the rearview mirror. The problem had been licked, and now we can just kind of move forward. And the Fed seemed to confirm that just yesterday with a quarter point rate increase. And now today, we have this wild jobs report with over 500,000 new jobs. The expectation was only 100,000. And so now all of a sudden, people are wondering, well, wait a second, does this mean that labor costs are going to, go back up, that the economy is overheating, and now the Fed's going to have to raise more? So I would say literally from week to week, we're being whipsawed between expectations of whether inflation has been conquered or not, whether the economy is going to have a recession or not. And I think probably where we're sitting at this moment is you'd have to say that the risks of inflation returning are slightly higher, but the risks of a recession are slightly lower because with this kind of jobs report, better chance of having a soft landing here. So I just think that we're in a highly volatile economy and it's very hard to predict the future. I'd say that relative to where we were a month ago, you'd have to say that the odds of us having a soft landing this year are quite a bit better than they were.
I think Sachs is right. I think the marginal risk here is for this whipsawing. So we have a period now which is disinflationary. But the problem is if the stock market keeps going up and all of a sudden we have less restrictive monetary conditions, then we're going to be back at the same place we were before, which is money sloshing around into all kinds of risky assets or more money. There's still an enormous amount of money sitting on the sidelines that has to come into the market now if this thing keeps going higher. So we're in a delicate moment. And if we reignite inflation because all of a sudden more companies have more liquidity that they can tap, right? More money they can raise, more money as a result that they can spend. because we don't have this first inflationary cycle under control, there could be a risk that we reignite inflation. And so then they have to capitulate, the Fed has to capitulate again and start another hiking cycle. So I think it's a complicated moment. I think all of the smart money in Wall Street that I talked to up until this point, they forecasted like this period would be choppy and the second half of the year would be really robust, and like you needed to be super long and things were going to be incredible. And when I talked to them this week, they're like, oh God, we weren't positioned for this. We had no risk going into this. We're going to be forced buyers. There's a bunch of companies that are whispering that they want to go public now. The big banks have been calling around trying to book build quietly for some IPOs. And so if they try to kind of crack this capital markets open, the thing that we have to think about is like, most of the market are not people, right? Most of the market are computers and algorithms and ETFs. It's an extremely formulaic buying model. You have components of an index, those represent certain percentages. You have to own those percentages to be relevant as that index. And so it's this reinforced buying loop as well as a reinforced selling loop, right? So when things start moving, those folks have to just systematically move money in. All the humans know that. So the humans tend to front run all the computers, and they basically are the ones that sell into these guys. And then that's what inflates these prices. Similarly, on the way down, humans try to front run it by being short into that stuff. So we could see the capital markets open. Even if we don't, it's actually the worst scenario because now you have all this money going into a fewer number of names. That sort of explains Facebook has doubled in 30 to 60 days. Tesla has doubled in 30, 60 days. A lot of the tech stocks, like high beta stocks that we are all, helping to build, those companies have just absolutely ripped 60 to 100%. These are not healthy and normal moves. And so the question is what happens if inflation somehow all of a sudden pokes itself back up? Right now, it doesn't look like it is. And Powell was clear, and it's true. We're in a deflationary cycle.
Well, he said
cycle.
Deflation 11 times during his, he's
we're in a
very clear
cycle.
about his use of language. Yeah.
That's why the market ripped. I mean, basically, that was all part of a narrative where inflation's on its way out. We've licked that problem. And that's what the market was pricing in. And I think now the question is, in light of today's jobs report, is that actually true or not?
And I'm sorry, disinflation, not deflation.
Disinflation, yeah.
Disinflation.
So I think, one way to look at this is, Jake, how you showed the chart of the Fed funds rate. Another chart is the yield curve. Can we just pull up the yield curve for a second? This is the yield on U.S. Treasuries on, RT bills. And one way to look at this is as a prediction market of where the market thinks interest rates are going, because the Fed sets the rate for the Fed's funds rate, which is the overnight rate of lending to banks, but they do not set the rate of, 3 months, 6 months bonds, 10-year bonds, and so on. The market does, because the market trades those bonds and it imputes a yield that the market requires to want to hold those bonds.